With the market having turned its engines to full mode with the new year, we're about to take a look at what next week has in store for the markets. On the monetary front, a number of policymakers from various central banks are to make statements and sway the market's opinion. More specifically though, we highlight the release of BOJ's interest rate decision on Wednesday, while we also note the release from Turkey of CBT's interest rate decision on Thursday. As for financial releases, we make a start on Monday with Japan's corporate goods prices for December and Germany's CEF indicators for January. On Tuesday, we get China's GDP rate for Q4, UK's employment data for November, and Canada's CPI rate for December. On Wednesday, we get Japan's machinery orders for November, UK CPI rates for December, the US retail sales for December, and industrial production for December. On Thursday, we get from Japan the trade data for December, Australia's employment data for December, and from the US the weekly initial jobless claims figure and the Philly Fed business index for January. On Friday, we get Japan's CPI rates for December, UK retail sales for the same month, Sweden's GDP rate for December, and Canada's retail sales growth rate for November. The USD is about to end the week weaker than its counterparts. We have to note though that the release of the US employment report tended to support the idea that the US employment market is still tight, given the drop of the unemployment rate despite the drop of the NFP figure. The employment data tended to provide a green light for the Fed to maintain its hawkish stance. We should note though that the release tended to provide a breath of life for the Fed's expectations of a soft landing, and St. Louis Fed President Bullard's comments were characteristic. At the same time though, the fact that the US CPI rates for December slowed down tended to solidify the market's expectations for an easing of the Fed's aggressiveness and thus tended to weaken the US dollar. On the monetary front, we note that Powell's speech at Sweden's Riksbank symposium failed to actually excite traders, as the Fed chairman refrained from making any substantial statements about the outlook of the monetary policy of the bank. Nevertheless, the opinion that it's time for the Fed to downshift to 25 basis points rate hikes seems to be gaining traction among Fed policymakers, and Philadelphia Fed President Harker's comments about this issue were characteristic. Lastly though, we tend to note the worries created by the contraction of economic activity for the US services sector, as a note by the release of the US ISM non-manufacturing PMI figure for December. Mind you that it's the first contraction of economic activity for the US services sector since the pandemic. In a similar fashion, also the drop of the factory orders growth rate into the negatives tends to intensify the worries also for the manufacturing sector. The pound is about to end the week stronger against the US dollar, seems to be edging lower against the JPY, and is losing ground against the euro. At the fundamental level, Rishi Sunak managed to stabilize the situation the last quarter of the year and ease the market worries for the UK government. On the other hand, the government still has a huge cost of living crisis, and any efforts to boost the economy could intensify the issue. At the same time, it should be noted that the International Monetary Fund is expecting the UK economy to grow at the slowest pace among other developed economies. Also at this point, we have to note that Brexit costs are ever present for the UK economy, while the war in Ukraine is ongoing, implying that more military assistance will be required by the UK. On the monetary front, we note the words of BOE's Catherine Mann that the price caps on energy may be redirecting inflation in other areas. In a similar fashion, BOE's chief economist Hugh Pill noted the risk of persistent inflation from the tight employment market despite the possible drop of energy prices. Hence, we tend to highlight the release of the CPI rates for December on Wednesday and employment data on Tuesday. JPY is about to end the week stronger against the US dollar and GBP, while it seems to remain rather stable against the euro. The Japanese yen got some support on Thursday after the release of a report stating that BOJ is to review in its next meeting the side effects of its ultra-loose monetary policy. The report also tends to maintain the view that more efforts are to be taken to alter the yield curve control policy. It should be noted that the bank had altered the YCC already in December, as it rose the yield of Japanese government bonds to 0.5% to actually intervene and start buying JGBs. In the coming week, we highlight the release of Bank of Japan interest rate decision on Wednesday. The bank is expected to remain on hold, keeping the interest rate at minus 0.10%, yet currently JPY OIs provide only a 52.6% probability for such a scenario to materialize, that being only marginal, with the rest implying that a 20 basis points rate hike is also possible. We expect that should the bank proceed with any tightening, it may focus primarily on the YCC rather than the interest rate as such. Also, some adjustment to the amount of bonds the bank is buying could be expected, as the unlimited amount, as mentioned in the previous accompanying statement, may be setting the bank in direct contrast with the markets. Overall, we may see a subtle yet concrete alteration of the bank's ultra-loose monetary policy, which could support JPY. Should the bank fail to excite traders, we may see JPY weakening. The common currency is about to end the week stronger against the US dollar and the pound, yet seems to remain rather stable against JPY. The results of the week tend to showcase the influence that monetary policy differentials tend to have in the FX market. ECB seems to be sticking to its guns and is to maintain a hawkish approach regarding its monetary policy. It's characteristic that ECB board member Schnabel stated that inflation won't subside by itself, implying that more monetary policy tightening is required, while ECB's chief strategist, Philip Lane, in a similar tone warned that inflation in the Eurozone is to remain elevated despite the possibility of rising energy costs starting to ease. Overall, we tend to maintain the view that ECB's tightening is to continue on a steady basis, and that could provide some support for the common currency, especially against the US dollar, as market expectations are for the Fed's hawkishness to ease currently. On a macroeconomic level, there are a number of signals that tilt on the positive side for the Eurozone, yet nothing conclusive yet. It's characteristic that the industrial output of Germany got out of the negatives for November, while Eurozone's preliminary HICP rate for December slowed down below 10%, reaching 9.2% year-on-year, while the area's retail sales growth rate for November accelerated, getting out of the negatives. It seems as if the Eurozone is on the right track, yet the worst may still be ahead. AUD is about to end the week stronger against the US dollar for the fourth time in a row. On a fundamental level, we note that China's reopening may have provided some support for the Aussie, given also its second nature as a commodity currency, and the fact that Australia exports a wide amount of raw materials to China. China's reopening is expected to be bumpy, with the number of cases possibly rising, yet in the grand scheme of things is sending positive signals to the world markets, as a possible economic recovery could soften the blow on a global level. In the coming week, we expect the markets to focus on the release of China's GDP rate for Q4 2022 on Tuesday, and a possible acceleration of the rate could improve the market sentiment, supporting risky assets such as the Aussie. On a macroeconomic level, we note that the release of the CPI rates held a surprise for Aussie traders, as inflation accelerated on year-on-year level for November, while the retail sales growth rate accelerated beyond expectations, showing that the average Australian consumer is willing and able to actually spend more in the Australian economy. The release could cause a more aggressive hawkish stance on behalf of RBA, which had eased its hawkishness, especially given that the bank is to examine its interest rate decision on a case-by-case basis. The next area of interest is the employment market, with Australia's unemployment data for December on Thursday. Should the data show that the Australian employment market remains tight, we may see the Aussie getting some support. The CAD is about to end the fourth consecutive week stronger against the US dollar. On a fundamental level, the rise of WTI prices could be providing some support for the loonie, given that Canada is a major oil producer. On the commodities front, we note that oil prices were on the rise yesterday, despite another massive rise of US oil inventories being reported for the past week, as hopes increased demand from China surfaced. Analysts tend to mention that China's needs in oil are to rise substantially due to the new lunar year festivities and changes in its COVID policy. Should oil prices continue to be on the rise, we may see the CAD getting some additional support. On a macroeconomic level, we note that the release of Canada's employment data for December last Friday, the release highlighted the tightness of the Canadian employment market, as the unemployment rate ticked down instead of rising as expected, and the employment change figure rose to a stellar 104K. The release tends to intensify market expectations for BOC to hike rates in its next meeting. It should also be noted that despite BOC's rate hiking path, the building permits growth rate accelerated to 41.1% month-on-month for November, in a positive surprise for CAD traders, implying wider economic activity for the Canadian construction sector. In the coming week, we highlight the release of Canada's CPI rates from December on Tuesday, and a possible acceleration could provide some support for the CAD, as it could intensify the market's expectations for a more hawkish BOC. In the coming week, we expect the US dollar to learn some of the initiative to other currencies, given the frequency and gravity of US financial releases tends to ease. Such a development could allow for a more balanced blend of trading opportunities for market participants, yet market attention may start shifting away from the FX market and towards the US equities markets, given that the earnings season has kicked off. Today we get the earnings releases of large banks, namely JP Morgan, Bank of America and Citigroup, while the chorus of large banks is to continue on Tuesday with Goldman Sachs and Morgan Stanley. On Wednesday, we note the release of the earnings report of Alcoa, and on Thursday of Procter & Gamble as well as Netflix. A possible shift of the market's attention may lower volatility in the FX market, while the lower number of high-impact financial releases may allow for fundamentals to take a more active role in the direction of the FX market. As for gold's price, note that it's about to end the week in the greens, with the precious metals price benefiting from the weakening of the greenback. We expect the negative correlation of the two trading instruments to be maintained in the coming week, and should the US dollar continue to weaken, we may see gold's price gaining further. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Hello, my name is Christina, and today I will talk about GDP. Gross domestic product is the monetary value of all goods and services produced in a nation during a given time period, usually a year. Basically, it's a record of everything bought for money during the course of 1 year. Consumer purchases from a chocolate to a car and counted in the GDP. When businesses buy computers or export goods overseas, the transactions all increase the GDP. Government spending also contributes to the GDP. A related statistic is the GDP growth, which is a percentage that shows how fast the economy is growing. If the annual rate of GDP growth is 3%, that means the economy is 3% larger than it was the previous year. The rate of GDP growth changes depending on the health of the economy. During an economic downturn, the economy contracts and GDP declines. For example, the recession that lasted from 2007 to 2009 was a severe period of economic decline. A GDP figure that shows strong economic growth means that businesses are making money and can hire people. Unemployed people are more likely to find a job, and consumer spending rises, leading to more profit for businesses and even more hiring. Government leaders analyze GDP reports when creating economic policy. The US Central Bank, the Federal Reserve, uses the GDP report to gauge economic activity. Investors look for signs of sustainable economic growth in the GDP report, paying close attention to the information it contains, especially corporate profits. Business leaders analyze the economy's performance as is reflected in the GDP report, so they can decide on future investment and production. As a measure of the sheer size of the economy, the GDP provides economists and ordinary citizens alike with a convenient and accurate measure of economic vitality or the lack of it. Thank you for watching.
Good afternoon. Hi, Atur. Hi, Owen. Just want to check that you guys can, before we get started, you can hear me okay? You can see me all right? Let me know, put it into the chat. Sound and screen okay? Fantastic. Seems like everything's okay. We'll give it a couple of minutes before we get started. And while we're waiting, let me know where you're joining me from. And I hope you've had a good trading day, or trading week, or good start to the new year. And a happy new year to everyone as well. Hey Techno, how you doing? Hey Aya. We'll see who else streams in before we get started. Give it a couple of minutes. Today we're here with IronFX on the webinar series Mastering Divergence in Trading. Quite a number of things to get through today, so it'll be quite an interesting session. I hope you find it an interesting session and helpful as well. Hi there from Germany. Good to see you. Hey Esther, how you doing? As we're going to be talking about divergence trading today, let me know if this is a strategy or method that you deploy onto your own trading as well. Do you use divergence? Do you trade with the divergence? I'm very well. I've had a couple of nice trades last night and also this afternoon, so I'm super happy with that. Hey Promise, how you doing? Fantastic, good to see. Does anyone attending the session use divergence in their trading? Why I'm asking is just so that I know, how fast or how slowly or how much detail to get into, customize the session a little bit more for you guys. And do let me know. Alrighty, let's get started. So again, welcome to everyone attending the session, and thank you all for attending the session. I know a couple of you have been waiting to join up, so thank you all for attending early and welcome to the session. Today we are here with IronFX on the webinar series Mastering Divergence in Trading, right? So before we get started, a quick disclaimer is that any information in this webinar should not be construed as investment advice or an investment recommendation, but instead as educational material only. This material is the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you some ideas, some thoughts, the way to deploy divergence in your trading. What I do usually recommend is that whatever you learn here during this session, I would suggest that first you test it out, right? You read up a little bit more about it, you understand it a little bit better, then test it out on a demo account first, right? Never jump straight into a live trading account with a new strategy or a new method. What you're gonna do is test it out on a demo account. Make sure that you understand how it works. Make sure that you're able to identify the way it works on a demo account. Then you progress on to trade it, I would say, on a smaller trade, right? So size down when you go into a live account, size it down, test it out further. Once you gain that confidence with the method, then you can resume and possibly integrate it with your existing trading strategy. Okay, so these are all, I feel, complements to your trading strategy, not something that I think should overtake whatever you're currently doing. All right, so a quick introduction. My name is Jin Dao. Most of you will know me as Jin. I'm been trading for 10 to 15 years now already, so quite a long time. If you do have any trading related questions, please feel free to reach out, let me know. I'll be happy to address your questions as they come up. Okay, so today we're talking about divergence when we are in trading, right? Using different price levels and also the tools and indicators to help us to identify possible divergence. All right. Good to go. Any questions at this point? I do see that a couple of you are new to trading. So what I would suggest is that, this might be something that you want to look further into. It is a very powerful and quite commonly used method that a lot of traders monitor and deploy with their trading. So I think this might be a good starting point, right? And it's relatively simple to understand, relatively simple to analyze and to deploy. So it might be something that you might want to look into a little bit deeper as we progress through this session. So with that, let's get going. A couple of things to get through today. First off, obviously, what is divergence in trading, right? What is divergence in trading? And, as the word, let me just get that up. As the word suggests, divergence, right? Just plainly explained, in divergence means one thing is going towards upside and then something else is going in opposite direction, right? Obviously, everything is moving towards the right, but one is moving higher and then something else is moving lower. Or in the flip side, I should change the color. Let me just do that. All right. Or on the flip side, one goes down and then the two goes up. That's a terrible color. Sorry about that. Okay. So first off, what is divergence in trading? That's when we actually see price moving. So I always say that top level here is price. Price moving in a different direction to what the indicator is telling you. I can't scribble the mouse, but what the indicator is telling you. So very commonly, most often, we always see, price moving in the up towards the upside, and then we see the indicator pointing towards the upside. So this is the common view, is that we see price pushing higher, while the indicator, for example, the RSI, is pushing towards the upside as well. So that's what we saw. We say a confluence, we would say it's moving in alignment, right? Indicator pointing in the same direction as price. When it comes to divergence, it's when price moves up, but we actually see the indicator pointing towards the downside or moving lower. What indicators can you use to identify a divergence? First off will be price at the top, but in terms of indicators, we can use the stochastic, right? We can use the stochastics. We can use the RSI, or we can even use the MACD, the moving average, convergence, and divergence. Quite commonly, the question I'll get when I come to this point is that, people will be asking, so which is better? Should I, is the stochastic better than the RSI, or is the RSI better than the MACD, just based on the sequence that we're sharing? There's no better indicator to use. It all performs in a similar fashion, right? All performs in a similar fashion. But what it should actually tell you a similar story, identifying that similar setup for you. So it really doesn't matter whether you use the stochastic, the RSI, or the MACD. Sorry about that. I'm still coughing terribly, so just bear with me there. Okay, so different indicators still would tell you a similar story. Then after that, on point 3 here, so this is 2, and this was 1. On point 3 here, we have different types of divergence. Different types of divergence. There are normal divergence, there are hidden divergence, and the exaggerated divergence. Now, put it into the chat. What do you think is going to give you a bigger possible potential move when you identify divergence? Normal, hidden, or exaggerated? What do you think is going to give you a bigger price movement? Normal, hidden, or exaggerated? Okay, right? Yes. So good stuff there, right? It exaggerated tends to give you, or would tend to give you, a bit more of a potentially bigger price movement. But there are other things to consider, not just the types of divergence. And then with that, when we understand how to use the indicator, how to identify the different divergence, we'll combine them all together to look for our trade setups. Okay, so quite a number of things to get through today. At any point, if you do have questions, please feel free to put into the chat, let me know. And also, if time permits, what I'll do is at the end of the session, I'll jump into a live charts and try and identify some divergence or live occurring divergence for you guys. Sounds good? Alrighty. So first off, jumping ahead a little bit, the different types of divergence. Like I was telling you, okay? So I remember that on the top, splitting this, on the top is price, on the bottom is indicator. So there's the blue line and the red line. That's the regular divergence. The hidden divergence, again, price and indicator. And then the exaggerated divergence in terms of price and indicator. Okay, so how do you identify a divergence? Right, let's look at the regular divergence first. How do you identify a regular divergence? We split the divergence up into a bearish divergence or a bullish divergence. As the name describes, if we have a bearish divergence, what we anticipate is for price to drop strongly. If we have a bullish divergence, then we anticipate that price should climb higher. So things to pay attention to is the turning points on price, right? So we're looking for price to move up, turn back down, move up again, turn back down. So we have a higher high, and then another higher high. So when you have higher highs, you say that that's the first part 1. Okay, this is what we have here. And then you look at the indicators, right? For example, in this case, let's say the RSI, and you're looking for it to form a lower low. So in this case, as the indicators might go down this way, bounce back up, turn back down, and then turn this way, you say this is a low and a lower low, right? So you say that we have a divergence, a bearish divergence. Price forming higher highs, or the peaks of price forming higher highs, and the indicators forming lower lows. All right, so with that, we will anticipate that price would retrace or correct towards the downside. Remember, the things to remember here is that when you're looking at bearish divergence, you're almost somewhat identifying a upward trend line, right? Or trend line that's resisting, providing that resistance to price, right? So it's hit the price resistance once, twice, and then a big retracement towards the downside. In terms of a bullish divergence, you're looking for a lower low in terms of price, a lower low in terms of price, and a, when price goes this way, no, let me do that again. All right, so when price goes this way and then this way, so now we have that trend line towards the downside, and then we have a lower, a higher low, right? A higher, this will be a lower high. Pardon me, this will be a lower high. Then we have that divergence towards the upside. So they will call this a bullish divergence. Okay, so I'll take that away. I think the regular divergence is relatively straightforward in terms of identifying it, because we're looking for that higher highs and the lower highs in terms of the bearish, and the lower lows and the higher lows in terms of the bullish divergence. What happens with the hidden divergence? What happens with the hidden divergence is when you actually see price moving lower. So you have in this case, a high, and then we have a lower high, while we have the indicator actually giving us that, a high and then a higher high. All right, so it looks like it's pointing towards, it looks like those lines will be converging, pointing towards the same meeting point. That's what we'll have, the hidden divergence, a bearish hidden divergence. And then when we look at the bullish divergence, it actually separates out, it points further apart. You can see here, it's formed by a low and then a higher low, right? A low and then a higher low, while the indicator will be formed with a low and then a lower low, where you would have the divergence pointing in separate directions, one pointing towards the upside, one pointing towards the downside. That would say a bearish, or rather a bullish hidden divergence. And then lastly, the exaggerated divergence. That one is relatively straightforward to identify, because we're looking at price not forming that diagonal move, right? We're not looking at a higher high or lower high in what we had on the regular or the hidden divergence. What we're looking for in the exaggerated divergence, whether it's bullish or bearish, we're actually looking at price trading or forming a good strong horizontal resistance or horizontal support level. Okay, so you can see here where we have here at this point, price testing, before testing again, horizontal level, right? A horizontal resistance, not looking for the higher highs or higher lows, and then but the indicator forming a high and then a lower high, right? So you have price resisted to move towards the upside, but yet you have the indicator pointing towards the downside or trending lower. That's why we say we have the exaggerated divergence on a bearish note. And then on a bullish note, we'll have it forming a support level, right? At a support level, while the indicator is forming a low and then a higher low, indicating further upside or indicating that bullish potential. All right. So quite a number of things to take note of in terms of identifying or understanding the different types of divergence. While this session is being recorded, what I will also suggest to you guys will be to, take a quick snapshot or do a quick scribble in terms of the the 6 different divergence: the bullish, the bearish divergence for the regular, for the hidden, and also for the exaggerated divergence, right? So this, you can use it as a quick reference guide. Okay, so if you have already, great. If not, let me know. I'll come back to this slide again. So looking at it in terms of on a chart, it's fine. It's relatively easy to identify it when we're looking at it with lines purposely drawn to identify the divergence. But how does it look like on a chart? We have the examples here. You can see that firstly, price is testing a resistance level, right? It's formed. It's almost, if I can draw a horizontal line, you can see it's formed right across, right? Forming a little bit of a smaller high, resulting in a bearish divergence with RSI. So it's tested a bit across, but you can see that in this case, it's moved up a little bit, right? So we're talking about small movements. It can also sometimes be quite obvious, right? Sometimes it's quite hard to identify a divergence or bearish or bullish divergence, but sometimes it's going to be quite obvious. In this case, as a first example, almost horizontal, almost like an exaggerated divergence, but we also would say that it's a bearish divergence here. And then you can see RSI first at this point, and then trending lower, right? So this is a little bit more obvious. You can see it pointing towards the downside. So we either have it going up like that slightly, potentially, and then after that, the RSI forming that. Oops, I'll draw that better. And then the RSI forming that move lower again, right? So we're looking at that. And then if I scroll back, you can see that for this to point up and this to point, the indicators trend to point down, right? Pointing up and pointing down, or moving right across and pointing down. So this would tick the examples of either a regular divergence or the exaggerated divergence, which still would give us the indication that we're looking at a potential bearish move towards the downside. Okay, so you can see here, price moving across, right across or slightly towards the upside, and then the RSI here moving slightly lower, right? So we see that divergence, that bearish divergence. And what happens? You see that price traded strongly lower, right? Strongly lower, not just because of the divergence, right? Price reverses strongly from that horizontal resistance level. It also traded lower because the RSI traded down, right? From the overbought region to the almost towards the oversold region. And also because of that bearish divergence. So what I'd like to do, right, as much as we're talking about the divergence here, right, as much as we're talking about the divergence here, I wouldn't recommend, entering a trade just because of a divergence. I wouldn't do it just because of a divergence, right? I'll still be looking at, yes, I'll identify a divergence, but before that, I'm looking at support and resistance levels, right? You can see price resisting that resistance level. You could also be looking at the previous trend. And also you'll be looking at indicators just giving you that signal of where price could be heading towards. putting all that together, then after that, identifying a divergence gives you that confidence, right? Gives you that confidence because you get a confluence of analysis. You get many things put together, giving you the same signal, telling you that we're potentially looking at some downside. And that's why we see price having moved strongly lower. All right. At this point, any questions? Any questions at this point? Let me know. Or if it's all good, clear and good, let me know as well. And we'll move on. All righty. Okay. So with that, thank you, Esther. With that, we look at, again, another one, right? An idea of a repeated divergence. So now let me ask you, if you see a divergence and it trades well, and what happens? What do you think will happen if you see multiple divergence? If you see it happening over several times? Most likely going to give you a stronger signal, right? A repeat of what could happen. So in this case, quite straightforward. You can see that price pushing higher, right? Moving towards upside there. Oops, I'm terrible with this drawing. Right, you can see price forming a higher high. You can see price having a high there and then forming a higher high. But yet we see the stochastics. In this case, in this example, we're looking at stochastics forming a lower high, right? So this was the high point here, and then it's formed a lower high. So it's pushing towards the downside. Again, as price pushes up and the indicator, in this case, the stochastic pushes down, what we would have is a bearish divergence. And you'll see that, if I can just draw a straight line across, that was the previous resistance level, right? We saw a little bit of a break towards the upside. And then because of that bearish divergence, we saw price come strongly towards the downside. Okay, so this is also one good way or another tool to help you identify potentially some false breakouts. I always get questions from individuals that I coach in terms of how do you identify a potential false breakout. You could use divergence as price breaks out of a resistance level. You see a divergence form, you anticipate that price could trade back down again. In this case, you can see as the divergence forms, we see price trade lower. All right. So what is a repeated divergence? You see again, if I take that away. Okay, if I take that away, you'd see that now we have that high and that forming slightly lower. Again, a slightly lower high on the stochastics. Right? No, they're here. Okay, high there. One formed, and then after that, this formed here. But yet, price is moving towards the upside. Again, another bearish divergence. I was just sharing with you before, just as I was drawing that, why this wouldn't work is because as much as we see this moving a little bit across, a little bit towards the downside, we haven't seen price, or price rather has been trading right across. It hasn't really turned towards the upside. We haven't seen a higher high, right? Or we haven't seen it turn down from that resistance level. So it hasn't really formed a divergence yet from this picture, right? So we have one divergence formed here. And then as price goes up, you'd say that there's another divergence as we see this push higher while the stochastic pushes towards the downside. Okay. And what's very interesting here at this point is also to identify that this is a bit of a resistance level formed on the stochastics, right? It's also a resistance formed on the stochastic where you see that it's hit that level here and turn back down, again hit that level and turn back down, could be also considered as a hidden resistance level. Why is it hidden? Because we normally draw the resistance level on the price charts, not on the indicator chart. All right. So with this repeated pattern at this point, well, what could you anticipate? We'd say that we anticipate for price to turn down because of that bearish divergence. And that's where you see price shooting towards the downside as that bearish divergence forms, as it retraces or breaks out from that upward move. Okay, so we've gone through just a couple of divergence at this point. Firstly, the normal divergence, right? Just a quick introduction of the normal divergence, and then also the repeated divergence where you see where you see it happening once and a relatively small move towards the downside. But then after that, when you see it happen twice, a repeated pattern, you see a bigger move tracking lower, right? A bigger move towards the downside on the bearish divergence, because it's already happened once, small move, and it happened again, we see that big move down. Okay. So with the divergence, as we were looking at it, you have that high, that higher high. So this was a high point. This is a higher high. And then also when you have the stochastics or the RSI or the MACD giving you that lower high. I'm just trying to draw it properly. High point and then that lower high point, right? So when you have that pointing down and then that pointing towards the upside, we can pretty much identify where is an entry point. Where's an entry point is when the turning points align. Right? I didn't draw it exactly. I was just trying to struggle to draw it a bit. But when the turning points align, so in this case, you can see at that dotted line, I would say as the candle closes, just to ensure that you see that downward move or that pivot level, you'd say that that would be your entry level, right? Your entry level. Then the common question comes is, wait, so if I know that at this point, that's my entry to sell, right? The entry to, let me just do that again. It's terrible to try to write with a mouse. Right? That's where you would be looking to sell. Then what happens is the next question comes with, okay, great, Jin. If I'm looking to sell at this point, where's my take profit going to be? All right, where's my take profit going to be? This case here, where the divergence started. It could very well go a lot lower than that point, but you'd say that your first target could be at your take profit would be here. That'd be your first take profit level. You might be looking to close out half the trade at that point, right? What I would suggest is you could be looking at closing out half the trade, right? Or you could be looking at moving your stop loss to break even when price comes to that point. Or, well, you could be looking at closing out the trade completely with your take profit. Okay, so you say that if I'm looking to sell at the formation of that divergence, my first decision point will be at the take profit level where the divergence started. My stop loss, I would say, would be above that previous high as your stop loss level. Okay, so relatively tight. You tend to have relatively tight stop loss when you're looking at divergence, when you're looking to trade divergence. That's why I suggested at the start that this might be quite a good starting point for a lot of new traders, right? You have a relatively tight stop loss, and then your take profit. If you're not so risk seeking, you could be looking to close out exactly where it started, or you could be looking to close out half the trade or any amount of trade, or you could be looking to move your stop loss down to the break even level just to protect the trade and see how far down it can go. Okay. So in this case, you see that as we spotted that divergence, right? We were looking to sell at this point here. Our stop loss would be above, either above that previous high or above that divergence. I would say at about that point. And then your take profit would be at this level here. Okay, you see it come down, come close, bounce back up, and then after that, complete that reversal to hit your take profit level where it first started, where that first divergence started. Okay, in fact, here's another divergence that you could have entered on the shorter term. All right, and we say this would be the exaggerated version of a divergence. You can see that price moving right across, right? So a horizontal movement or horizontal resistance on price. And yet we also at that point see the RSI in this case forming a high and then a lower high. So with that, if I can draw a straight line down, almost did it, right? As that forms, you see that price shot towards the downside with that divergence forming as well, right? So it's not just that big move that you have identified. You know, you can identify other potential divergence within one move, right? So you could have one trade. I would say this would be your first trade. And then as price comes down, bounces back up, you form another divergence. And then this would be your second trade towards the downside. This would be number 2. Okay, so in one move, you know, over a medium long period of time, you could have multiple divergence being formed. I didn't see that question there. I didn't see anyone raise that question. You know, when, so commonly what the question I'll get is when, in terms of time frame, can you use or can you look to identify a divergence? So this can be done, or divergence can be identified on any time frame. Okay, you could be looking at it on the daily time frame. Oops, not the P, it's a D. Right, so you could be looking at it on a daily time frame. You can looking at it on the H4. You could be looking at it on the H1 even, right? But you know, as much as it'll work across everything, I would say that you know M15 might be the lowest that you go down towards. Right? I wouldn't actually look at anything lower than that, because what happens is that you know anything lower than H1 tends to get a little bit noisy. You see price fluctuating around with quite significant or choppy price movements. So if you try and identify it on too small a time frame, what you might actually get is possibly a lot of divergence in terms of occurrence of a divergence, but it might not all play out very well. Okay, so I would say that if you really have to, or if you should keep it to the daily, the H4 or the H1 time frame. And if you really, really have to, with nothing else to do, then you might consider the M15 at the very lowest. I wouldn't trade it any lower than that, any lower time frame than that. Fair enough? Good stuff. Okay, so with that, right, we'll be looking at forecasting, right? Forecasting, we put it all together. We try and identify where price could be heading or has been heading, and then how it could turn with a divergence. In this case, you see that the RSI broke the trend line or broke the supporting line before price did, right? You see that that moved down, but yet you identify this. Okay, you identify a lower high, and then here forming a, in this case, a higher high, right? A higher high. So straight away, we can see that a bearish divergence is formed. In this case, using the RSI, a bearish divergence is formed. Price broke the RSI broke the ascending support, indicating that price might trade significantly lower. Then after that, we look into price breaking out the ascending support line, right? Showing again, similar to what we identified on the bearish divergence, because at that point, we're anticipating for price to move lower. We're looking for that big downward move. Okay, so you're actually combining a few analysis together. Not just, remember, it's not just the divergence. You're looking at trend. You're looking at support, resistance. You're looking at the indicator itself. All that add together with the divergence. Sorry for the scribble. What it ends up with is we're going to see a higher probability trade setup for a potentially big move towards the downside, right? And you see that big push as it not only has a divergence, but it breaks the trend line as well. Fair enough? All good so far? Okay. Similar thing here. You see that price has been resisted by that trend line, right? Price has been resisted by that trend line as it trades lower, right? As it trades lower, first thing, how do you like get ready or get preempted to look for potential divergence is when you see the indicator giving you that early signal, right? You see that trend line towards the downside again on the RSI here, and then the indicator, and it gets resisted here, looks to break out of that trend line, of that downward trend line. With that, you'll be going, okay, great. It's looking like, or the indicator is indicating the potential for some upside. From there, you'll be looking at, can I identify any potential divergence? So in this case, you see price forming a lower low, right? Price forming a lower low, but the indicator forming a higher low. So what happens when you have a lower low in terms of price and a higher low in terms of the indicator? We're going to have a bullish divergence, right? It forms up with a bullish divergence. And as the RSI breaks above that trend line, we're going to see that potential for the upward move. Even as that divergence is formed, let me just do that straight line again to the best I can. Right, even as that divergence is formed, we already see price moving higher. So that's your first move. Sometimes you will not be able to catch that move straight away. You might not be looking at the charts during that time. You will see a divergence or bullish divergence formed. You might have missed that first move, but as price looks to break out of that trend line, break above that trend line, you can also see that if it breaks above that trend line, I have a bullish divergence supporting this analysis for that potential move or big move towards the upside. And then you can see that as it breaks out, we see not a steep move, but we can see price trading higher along with that bullish divergence and that trend line. Okay, so this is another way to add on, all right, add on to not just a plain divergence. You'll also be looking at adding the trend line to it just to help you identify a potentially bigger move as well. Okay, so sometimes as I teach a lot of traders how to use a divergence, they might not spot it right at that point because you're not watching the charts. But if you identify a divergence after it's happened, you could also be looking for additional information as it breaks above a trend line or a resistance level. You're going to see a potentially bigger move towards the upside or the downside. Any questions so far? All right, we've come to the end of the slides. So I just want to check if you've got any questions so far. Just let me know. I'll give you a couple moments to check, to type it up if you've got any questions. Okay. This is recorded. I think you can possibly head to the YouTube channel. I'm pretty sure it will be uploaded there. If not, you can probably reach out to one of the guys at fantastic guys at IronFX. I'm sure they will be able to get you a version or recording of this session. All right. Oops, let me move that away. Okay, so like we were talking about, okay, so we're going to try and identify a couple of potentially divergence levels. Okay, so what you want to look for in terms of a bearish or bullish divergence. Let's look for a bearish divergence. This is on the, let's do on the H4 time frame. The hidden divergence is just when you have price. Let me just try and draw that out. Okay, so a bearish divergence is when it points, price does that. Okay, and then the indicator points this way. Okay, so you have a not the best drawn, but a lower high, lower high, and then you have a higher high on the price. For a hidden divergence is when it points in this direction. When price has a lower high, but yet the indicator is forming a higher high. Okay, so you're comparing these two together. Right, so it's just pointing in different directions. Both of them are bearish divergence. Both of these are bearish divergence, but you just have price pointing in a different direction compared to the indicator. Does that answer your question there, Promise? Fantastic. Good stuff. Okay, so let me try and do this. Let's see if we can identify a couple of divergence. Tricky to do it on the spot straight away, so just bear with me for now. We could actually be looking at no, that doesn't form. Okay, so things to watch out for when you're trying to do a divergence. You can see that price in this case trading, forming a lower high, right? Forming a lower high in this case. And then after that, so you would think that maybe I have a hidden divergence here, but you say that on the RSI, this is also forming a lower high. So it doesn't work in this case. You don't want to try and force the analysis. We do have, nope, not here. Might have something here. A lower high formed, and then not the best. It does get tricky when you try and find something on the spot. Okay, let me just try and find another different chart, something that moves a little bit more steadily. Just wanted to make sure that I try and give you guys an example. All right, do we have something here? Okay. So we have price forming a higher high. Okay, so this is how we're looking at it. Price forming a higher high. And then after that, the indicator forming a, oh, don't have it there. It's supposed to turn to be down this way, so it didn't form. Well, I was hoping to identify that. Okay, let's try this one. Price forming a downward move, and that's pointing towards the downside as well. I just want to find something. this way. Nope. It's all following in the same direction. Trying to H1 time frame. We might have something here. Okay. So in this case, we have price forming a higher high, while we have the RSI forming a lower high. Okay, you can see that price forming a higher high where we see it going this way, while we have the indicator forming a lower high where price goes down this way. All right, so that is what we call a bearish divergence, a regular bearish divergence, and that's why we can actually see that as the price as the divergence forms. Right, even slightly before that, as divergence forms, we can see price trading significantly lower. And even this case, you can even say that it's formed right across, but I think that it's more accurate when you say it's at that point. All right, I'm glad I found at least one example for you guys. Let's see if we can find another one. So a higher high here, higher high here in terms of price on the, and then after that, the indicator forming a lower high. Okay, so there you have it. Another example here. Oops, as price forms a higher high and the indicator forming a lower high. Again, another bearish divergence formed on the USD yen on H1 time frame. All right, does that make sense? It's hard to try and find it, so I wouldn't suggest trying to sit there and look for the divergence specifically, right? I would say that how I deploy or how I use the divergence is that when I identify a trade and then I somewhat identify a divergence, it supports the analysis that I was doing. It supports my view that, or my previous view and my previous strategy as well. Okay, so don't go sitting there trying to spot only divergence. It's going to be a rather futile effort. I would say that it'd be better to try and look for that moves instead. Okay, so we can also see here price pretty much trading right across, right? Price trading right across, but yet in that same period, we actually see the indicator pointing, or the RSI pointing towards upside. What we have here is the exaggerated bullish divergence. You see that at that point, right, as that's formed, price pushing strongly upwards. Okay, exaggerated bullish divergence is when you see price testing the same level right across, while the indicator forms a lower or higher low. All right, does that make sense to you all? As we come to the end of the session, I hope you found the information useful and interesting and useful. Thank you, promise. And if you do deploy this onto your trading strategy, please make sure you test it out first, build that understanding, build that confidence level, first on a demo account, then on a couple of small trades, before you start trading and complementing it together with your own trading strategy. With that said, I wish you all good trading ahead. Remember, trade well, trade safe, and I'll catch you again. Take care now. Bye-bye.
Hello, my name is Christina, and today I will talk about GDP. Gross domestic product is the monetary value of all goods and services produced in a nation during a given time period, usually a year. Basically, it's a record of everything bought for money during the course of 1 year. Consumer purchases from a chocolate to a car and counted in the GDP. When businesses buy computers or export goods overseas, the transactions all increase the GDP. Government spending also contributes to the GDP. A related statistic is the GDP growth, which is a percentage that shows how fast the economy is growing. If the annual rate of GDP growth is 3%, that means the economy is 3% larger than it was the previous year. The rate of GDP growth changes depending on the health of the economy. During an economic downturn, the economy contracts and GDP declines. For example, the recession that lasted from 2007 to 2009 was a severe period of economic decline. A GDP figure that shows strong economic growth means that businesses are making money and can hire people. Unemployed people are more likely to find a job and consumer spending rises, leading to more profit for businesses and even more hiring. Government leaders analyze GDP reports when creating economic policy. The US Central Bank, the Federal Reserve, uses the GDP report to gauge economic activity. Investors look for signs of sustainable economic growth in the GDP report, paying close attention to the information it contains, especially corporate profits. Business leaders analyze the economy's performance as is reflected in the GDP report so they can decide on future investment and production. As a measure of the sheer size of the economy, the GDP provides economists and ordinary citizens alike with a convenient and accurate measure of economic vitality or the lack of it. Thank you for watching.